Resource Watch is brought to you in association with Tebe Investment Corporation.
Hello and welcome. The gloves are off in the global mining sector. That's what the conclusion of the PwC annual report said into that sector. We get to grips with the factors affecting the miners. I'm Tumisho Grater, and this is Resource Watch. Let's kick off with the market wrap for this week.
Wage negotiations in South Africa's gold mining sector have been set for 3 days starting on the 22nd of June. The talks will take place at a venue outside the Chamber of Mines and will have an independent chairperson. There have been calls for a measured, strategic conversation. Unions are seeking up to 84% salary hikes for the lowest paid workers. And JSE-listed mining company Petman wants to do a 350 million rand broad-based black economic empowerment deal. It's still subject to shareholder approval and will see a 20% stake in its Somkhele anthracite mine being acquired by employees and the local community.
We know that the local and global mining sectors are under pressure, but it still hits home when cold stats are presented. A recent PwC mining report shows overall market values plummeted $156 billion due to commodity price declines. The report also warns that there is a tough fight in store for miners. I'm joined by Andries Rossouw. He's a PwC partner, and he tells us more on this. Andries, thanks for your time.
Thanks.
Very big stat there, $156 billion that was wiped off. Just tell us first where we are in terms of the mining landscape. What have been some of the issues that has led to this point?
It's a shocking stat. I mean, it is where the industry was 10 years ago in terms of market stat. So what has driven it? Mainly low commodity prices, which has really put pressure on the mining companies themselves. There's been a big demand to try and cut costs in order to survive in this low cost environment, and companies had some success in getting there. But clearly a challenge, and investors are saying they're not overly optimistic about the future of the industry at the moment.
Talking about cutting costs, there has been debate there about what is actually driving this cost reduction.
Yeah, so we were pleased that despite an increase in production by most mining companies, we saw a 5% decrease in operating costs, which sounds fantastic. The reality, though, is that the bulk of that relates to local foreign currency weakening. And we've seen the rand weakening in South Africa, but equally so in Australia, Brazil, Russia, and India. And that has had a positive impact on cost. Also, the drop in fuel prices towards the end of last year had a big positive impact on input costs for most of the bulk commodity providers.
Capital expenditure and cutting back on this, that's also been one of the key themes that we have seen from mining companies. But you also talk in the report that you've seen a difference of the approach of the emerging market companies versus your developed market companies. Just tell us about the difference in strategies that they're employing when it comes to their growth and their expansion plans.
Yeah, so we saw a 20% decrease in capital expenditure from all these mining companies. That talks to the ability to survive the short-term needs and demands. But we did see, as you say, a big difference between the emerging markets and the developed economies. In the developed economies, the reality is shareholders are demanding dividends, and hence capital was reduced in order to pay dividends or borrow to pay dividends. On the developing economies, mainly China-backed, government-backed type entities, we saw capital expenditure still being done with a much longer term view installed from those entities.
You mentioned dividends there, and that's something that's always come up. We've seen Rio Tinto, BHP Billiton embarking on a progressive dividend policy. They said we are going to defend our dividend no matter what. Is this sustainable, and are we also seeing other mining majors, looking or employing the same practice?
Yes, overall the dividend yield for these 40 top entities was sitting at 5%. Talk about Rio Valley and BHP Billiton actually sitting at 6%. not necessarily due to high dividend payouts, but more due to the decrease in market capitalization. But there's a clear message from shareholders that they want dividends, and the companies have obliged. The reality is, in the long term, it's not sustainable. 2013, we saw companies actually borrowing money in order to pay dividends. This year, the dividend cover was at least 1.1, so net profit only just exceeded the dividends paid. But the reality is companies are not putting in the capital expenditure and using that cash to pay dividends. So when the cycle turns, those companies that are not investing at the moment might struggle to be able to supply and enjoy the upcycle.
Mm-hmm. Talking about upcycles, the commodity prices here, that's been one of the main culprits of why we're sitting in a situation that we are. What is the outlook for these commodities, and would you say that diversified miners are in a better position?
Well, yes, it is very much commodity specific at the moment in terms of where we see growth for the future. So I think it's fair to say that the demand side of the economy is still growing. China is growing at a slower pace, but still growing and on a much bigger base. One would have to say that on the growth side, the infrastructure expenditure in China is tapering off, and that growth is turning to consumer growth. So that has got a direct impact on the commodities that will be wanted in the future from Asia. Previously, iron ore, big demand when you build infrastructure. Going forward, copper, nickel and platinum, those more consumer-driven commodities are likely to be fueled better. And we are a little bit concerned, other than iron ore, also for coal. We saw yesterday the announcement from the G7 on trying to get rid of coal altogether. Mm-hmm. Won't happen overnight, but there's clearly pressure on coal and the energy mix that is changing at the moment.
Are we likely to see new markets for these commodities? You're mentioning China moving away. Where are we going to see demand coming from?
So we're excited about what India will do for infrastructure, and Africa later on. I mean, India, 280 million people still need electricity. In Africa, that number is well in excess of 600 million. Now, those are big numbers, and that will require a lot of steel, a lot of copper, a lot of infrastructure in order to support that. In Africa, I mean, our economies are very much commodity driven, and while prices are low, the demand for infrastructure, although big, cannot really be funded. So it will take a while for that growth to take off.
I'd like to just mention something else that we saw in your report, and one of the things that you talk about is maybe the reason behind the low iron ore price, and they refer to it in the study as the supply strategies that have been responsible for this. Exactly what do you mean by that?
So I mean, the reality is that to get a new mining project off the ground, it takes time. So a lot of the decisions around new developments were taken before 2008 when prices were booming, and really those investment decisions are only coming through in production numbers now. So it's a lag, what always drives the cycle. What we've seen though is that the main players have decided to continue producing and not to cut back on production in order to support the prices. And what that has done for the junior miners, that they don't have the backing of the big companies, is it really meant that they cannot survive and they've been pushed out of the market. Well, at least that's what they say. So there's a bit of a fight between them. We have seen different strategies, and a company like Vale has actually said that they will start cutting back production if prices stay too low for too long.
Regulatory environment, you said junior miners are complaining here, and it's very important that we do have policies that are conducive to make sure that we do have these mining companies that are able to thrive. What has been the trends when it comes to the regulatory environment and where it's moving?
Yeah, we actually had very different trends. I mean, when the cycle is up and mining companies are making profits, everyone pays for taxes. When the cycle is down, governments don't get the same income, so they are still demanding taxes. So we've seen some interesting moves up in Africa, Zambia, Zimbabwe, DRC, imposing royalties, increasing taxes, and really you don't want to tax the industry to death. We've seen some pleasing moves in Australia where carbon tax were abolished, and some of the super mining tax were reduced in order to support that industry. It will be interesting to see what happens locally. We're all aware of the Davis Tax Committee.
Yes.
And we're all waiting to see what they will come up in terms of the new environment. I think it's fair to say that it's not only on the tax side, but environmental pressures from regulators are playing a big role. We've seen some happenings in Chile on that. And then also
Are you making reference to the acid mine drainage in particular? Or
well,
any
in South
other?
Africa, but globally. I mean, there's a much bigger focus on environmental compliance and putting regulations in place. And that's probably necessary. The reality is what we mine today in a not so green fashion is really a tax on future generations. So there is a balance required in order to make sure that we mine clean and in a proper sustainable manner.
A few years ago, I went to a mining indaba and spoke to a couple of mining companies. This is what they had said. Of course, this is a few years ago, that they don't mind the high taxes. What they do mind is the uncertainty around it.
Yeah.
Are we still finding that that is, still what is coming through from the mining sector?
Uncertainty is certainly a big issue, and when you are certain, you can make investment decisions and you can plan accordingly. If the taxes are too high, though, the reality is the investment decision will be we're not going to invest. So there is a bit of a cut-off between that. Zimbabwe now with the export royalties on platinum concentrate, it really looks like some of those projects will not be profitable, and therefore the question is asked, will they continue? So it'll be interesting to see where that leads.
Andries, in the year going forward, there are obviously a lot of factors to take into account, but in your view, what would you say are maybe the top 3 things that are definitely going to either make or break mining operations?
Well, the reality is that cash preservation, so focusing on cost cutting, increasing productivity and efficiency of the resources you currently have, making sure that you focus on your core assets so that investments happen for those profit-generating assets and not the marginal ones will be key going forward.
Andries, thank you so much for coming in and telling us about what the report has to say, and of course alerting us to the key issues around the mining industry. That was Andries Rossouw. He's a PwC partner. That's it for this week's show, but do stay in touch at CNBC Africa, and don't forget our hashtag is Resource Watch. From myself and the team, see you next time.